Hello and welcome to all of you joining our webinar. As Oliver explained, we've organized this webinar following the publication of a we think important thought leadership paper, which is titled "A Time for Change in the Sustainable Fund Market." Now, our ambition with these thought leadership papers, which sit alongside the more formal standard work that we do in the market with things like the principles for green bonds, sustainable bonds, et cetera, is to try to think ahead and identify, firstly for the market, issues, potential recommendations, and also consider whether there's space for voluntary best practices in the area that we're talking about. It's also very much designed to engage with the policy and regulatory community, again, to identify important issues, think about what's working, what may not be working, and see if we can come up with recommendations. And as many of you know, in the sustainable fund space, there actually was a lot of new regulations, both at the referred to in Europe as level 1 and level 2, in the EU, of course, in the UK also. And so it was, we thought it was very timely to think about this and to publish. So with respect to our proceedings today, we're going to start with a quick presentation of the paper. This will be done by my colleague, Oscar Alton, and then we'll come back to the webinar, and I will then introduce the really good lineup we have here to discuss this really important topic. Over to you, Oscar.
Thank you, Nicholas, for this introduction. And I hope that you can see on the screen the presentation on our paper that Nicholas just mentioned, which came out in March. So I would say that this is a comprehensive yet relatively short paper. We look at the evolution and dynamics in the sustainable fund market from a historical perspective. Then we looked at integrity and greenwashing risks that have been much talked about. And then in response to these risks, the regulatory initiatives, especially on fund naming and categorization in the EU, in the UK, but also more broadly, as we are a global association. So we also looked at what has been happening in Asia and in North America. And then, obviously, these regulations will have an important impact on the structuring of the market. And we did an interesting in-house research as well, where we looked at existing market practices on ESG fund categorization of asset managers, as well as their regulatory sustainable finance, sustainable investment definitions, which I'll come back to. And then we finished the paper with some recommendations and priorities for the policymakers. So looking at the market dynamics so far, obviously we have seen a major growth in ESG-related fund market in the recent years, and observing an interesting statistic was that this is fundamentally a European market, as Europe representing more than 80% of sustainable fund assets. So like most of the market is actually European. As I mentioned, we have seen a major growth in recent years, but more recently there has been a loss of momentum, which mostly is attributed to macroeconomic developments, high interest rates, obviously some political issues like the ESG pushback, issues around greenwashing and tightening regulation. So there have been a lot of reasons, and I'm hoping that the panel after me will touch on those aspects as well. But maybe to finish this slide on a more positive note is that there has been a recent survey from Morgan Stanley and among a large set of asset owners and asset managers, and actually almost 80% of 300 asset owners and 600 asset managers expect sustainable funds to grow in the next 2 years as a result of new mandates and higher allocations. So maybe we shouldn't be too pessimistic because of the most recent, hopefully temporary dynamics in the market. So on the greenwashing risks, as I mentioned, due to the major growth in the market in the recent years, obviously the regulators were concerned that there could be some pragmatic approach to this ESG fund market with some beneficiarying approach. So this could lead to greenwashing concerns among the regulatory community. IOSCO published an important report in 2021 where it identified greenwashing risks for funds, and it's also focused especially on fund naming and labeling to make sure that the name of the product accurately reflects the nature and the extent of the product's sustainability. We also looked at that. We published a report on greenwashing in 2023, where we identified the notable areas of concern when it comes to integrity issues for the fund market. But I will say, interestingly, is that the data on greenwashing has so far been showing a mixed picture in terms of to what extent this is a risk, to what extent this has been an occurrence at scale. So basically, the ESMA final report on greenwashing, for example, did not find evidence of widespread greenwashing, but they also say in the report that this may be due to other reasons, such as regulators having so far taken a soft-handed approach and asking asset managers to amend the materially misleading information. Conversely, in jurisdictions like Australia, we have seen many greenwashing-related enforcement. So it's a mixed and nuanced picture when it comes to whether this is a risk, whether this is an occurrence. Well, in any case, we have seen a lot of regulatory action in the recent years, starting with principles-based approaches in different jurisdictions. These were then complemented with quantitative thresholds, high-level definitions and categorization for ESG funds, for disclosure, and then naming restrictions, and more recently, detailed labeling systems. So we have seen an escalating approach in the regulatory space in different jurisdictions. And in the paper, we are looking a bit more in detail what's been happening in the EU, especially around the EU SFDR disclosures used as implicit labels. We are looking at FCA's recent labeling system, which is a sophisticated approach. We are looking at ESMA guidelines, and we have an annex where we look at actually what's happening in Japan, in ASEAN, in Canada, in Hong Kong, and so on and so forth. So this is a brief presentation, but there are more details about how these regulations are supposed to work in our publication. We also have an interesting research, in-house research. We looked at the 10 asset managers with largest sustainable assets. 10 is a small number. Obviously, there are a lot of asset managers, but in terms of their assets weight, it's a major part of the market because they represent 35% of sustainable assets in the market. So we looked at their own and non-regulatory categorization of sustainable ESG-related funds, and we looked also at their sustainable investment definitions as this is defined under the SFDR. And there are some interesting results. On the left-hand side, you see the on and non-regulatory fund classification. And here, obviously, we face some considerable diversity and some lack of comparability among asset managers because some of them are referring to investment intentions and objectives when they classify their funds, and some of them are using terms around their investment strategies. So this has constituted a fundamental lack of comparability, but we still managed to identify some commonalities. For example, the category called sustainable enhanced or with relevant terms is quite common. The impact category is quite common. An ESG integrated category is quite common, whereas referencing the word transition in that context has been quite rare. Only 3 out of 10 of asset managers had a fund specifically referring the word transition or similar terms. And then they have been obviously various investment methodologies have been underpinning this category. So it's quite diverse in terms of what they apply, that these can include extended exclusions, positive sustainability characteristics, ESG ratings, best-in-class approaches, and so on and so forth. So a lot of diversity there. When we looked at SFDR, sustainable investment practices of asset managers, this is interesting because there's been more convergence of practices on that side. And we think that that's been a response to the SFDR Article 217, where there is a definition of sustainable investment, although it doesn't have clear parameters, clear thresholds. It still may have led to some degree of convergence in terms of practices. For example, for environmental and social contribution, we identify that a lot of asset managers are using 20% of SDG-linked revenues or CAPEX as a proxy. GSS bonds, green social sustainability bonds, align with ICMA standards and subject to asset managers' own internal assessments, it qualifies automatically as ES contribution. MDBs, vanilla bonds qualify for this sustainable contribution. And then for DNSH and minimum safeguards, there is also consistency because they are referring back to their exclusion policies, to controversy analysis, to exclusion of worst performance per ESG rating. So these log proxies that are being used are showing important degree of similarity. And also another interesting aspect was that all asset managers have proprietary ESG ratings, and they also all use both external and internal ESG data to make their analysis. And I'll finish with that slide. This is actually our priorities, ICMA views in terms of the future regulation for the market. First message that we are saying is that given that there has been a lot of regulatory action so far, especially in the EU in the context of ESMA guidelines, we are arguing that the future regulation under the potential SFDR review should be consistent and should not lead to yet another round of complete remaking of the market, because these regulations will have significant impact, and I'm hoping that the panel will also touch on that. However, we also argue that there could be enhancements, for example, in the form of a uniform disclosure for all regulated funds, not only sustainability funds, but all regulated funds, in terms of what's their exposure to credible transition plans. And this is with an intention to mainstream transition plans across the whole capital markets. And the second message of ours is that EU regulators should not restrict the assessment of sustainable investments solely to EU taxonomy, because that would be too restrictive for the market. And I know that speakers will touch on that, so I'll stop there on this. And the last point, again, this will be discussed comprehensively in the panel. This is about transition funds. So what can we do to make the transition funds see more uptake, especially when it comes to, let's say, more challenging, hard to abate and fossil fuel transitions, as we know that only financing green will not get us where we want to be, and we need to finance these sectors. But will the transition funds do the job? What can be done to make sure that they will see major uptake? I'll leave it there, and I know that most of these questions will be discussed in the panel, so I'll stop there. Thank you very much.
Well, that's good. Thank you very much for the presentation and the introducing our panel. Let me quickly present you the speakers who have kindly joined us. I'll start with Hortense Bioy, who is the head of sustainable investing research at Morningstar Analytics. We also have Vanessa Leblanc, manager sustainable finance policy at the UK's FCA, so from the regulatory side. We have Hélène Bussière, head of asset management unit at the European Commission, so arguably also policy. And then from the market, Laurence Caron-Habib, head of public affairs of BNP Paribas Asset Management, has also kindly joined us. So welcome. And let me turn first to Hortense. Hortense, Morningstar Sustainalytics does some great work in terms of monitoring what is happening in this space, and we wanted to start by asking you, what have been the impact of regulatory developments, both in the EU and the UK, on this part of the market, and how do you see this carrying forward in the next few years?
Thank you very much, Nicola, and good morning, everyone. It's a pleasure to be on this webinar. So to answer your question, I think it's clear when you compare Europe and the rest of the world that EU regulation and SFDR in particular has played a critical role in the growth of the European ESG market. I think it's fair to say that 5 years ago, before the introduction of SFDR in March 2021, absolutely no one expected that funds with ESG characteristics would end up representing 60% of the EU market. Now, of course, we all know that a lot of these funds, mainly Article 8 funds, have very light ESG approaches. They may just have a simple ESG integration approach and perhaps some basic exclusions. If we turn to our numbers, I mean, so the way we classify ESG funds and we have our own criteria for that, ESG funds still represent 20% of the European fund market, which is really significant compared to what we're seeing in the rest of the world. It's less than 2% in the US and in other jurisdictions. Now, 4 years on today, this landscape is being completely reshaped by the ESMA funding guidelines. We estimate that in the last year, the universe of funds with ESG key terms in their names, so funds in scope of the ESMA funding guidelines, has shrunk by 9%. And that about 16% of the funds dropped ESG key terms. Many funds, twice as many, in fact, have simply replaced one term by another because they want to continue to signal that they have ESG characteristics and they want to distinguish themselves from other funds that have no ESG characteristics. So this is our preliminary analysis, and we expect to see these numbers grow in the next few months when we have more data, and beyond the 21st of May deadline next week for the implementation of the ESMA guidelines. In the UK, we can already see the full impact of the regulation, the Sustainability Disclosure Requirements, SDR. It has created 2 universes. So we have one universe of labeled funds, and these are funds with a sustainability objective. But this is a rather small universe of 110 funds for the moment. And separately, you also have a universe of non-labeled funds. These are funds that claim ESG characteristics, but they represent 80% of the market of funds with ESG characteristics. So how can we expect the European market to evolve in the next few years? I mean, it really depends on many factors. It depends on investor demand, appetite for sustainability or ESG strategies in general. It also depends on external factors like geopolitics and the macroeconomic environment. We've seen these factors play an essential role in the past few years since the war in Ukraine. That investors have changed their view on fossil fuels, have changed their view on defense. So these are trends that are going to continue to shape the landscape. And finally, of course, we will have SFDR 2.0 scheduled at the end of the year. That again could also change the landscape if it's decided to remove Article 8 and 9 and replace this by product categories or not. And I may stop here. I have views on this, but I let my fellow panelists answer your questions now. Nicola, thank you.
Hortense, thank you very much. I mean, what I take away from just said is that the impact has been very significant. Is that fair enough?
Yes, absolutely.
Yeah. Okay, turning to Laurence. Laurence, you're an asset manager, represent an asset manager. How have you adapted to operate and contribute to sustainability in this new environment? I mean, what are your views on how sustainable investments should be defined from a regulatory perspective?
Okay, so thank you, Nicolas. Good morning to everybody, and thanks for the invitation to this panel. So as a preliminary comment, what I would like to say is that in BNP Paribas Asset Management, we define our mission as generating long-term sustainable value for our clients. So it means that sustainability is definitely at the core of our investment policy. So, of course, SFDR has been a very important evolution for us, and we have been fully supportive to the introduction of this new regulation. So fully agree with what Hortense said before on the fact that SFDR has contributed to reallocate capital to a more sustainable economy. So this is definitely a major step for integration of sustainability across the EU. And we are supportive as well to SFDR for the transparency it provides to end investors, and also standardization with possibility to compare products between them. So very supportive. It has been a major project for BNP Paribas Asset Management. So I can say that all teams in BNP Paribas Asset Management have been mobilized for the effective implementation of SFDR. So of course, people in product teams, portfolio managers, our ESG analysts, but not only, all functions have also contributed to this effective implementation, human resources, legal experts, but control function as well, compliance. So to say that it has been a tremendous evolution for BNP Paribas Asset Management. In terms of concrete actions, we have done a lot, of course, so I will focus only on the most important ones for me. So we have extended the database of companies for which we produce an ESG scoring, because of course, having data about these companies is a very important element for the effective implementation of SFDR. So a lot has been done about this internal ESG scoring, but of course, this is not sufficient. And then we had to select some ESG data providers. So this is the case for information about taxonomy alignment, but also information we need to produce the principal adverse impact indicators. So a lot has been done on this. And the outcome today, and another key action, of course, is the development of a proprietary methodology to identify sustainable investment. So a very strong, robust methodology, which is very transparent, that is public, and everybody can have access to this methodology. So as you can see, it has been a huge project, fully coordinated across BNP Paribas Asset Management. And the outcome is that today we have more than 90% of asset under management in our open-ended funds in Article 8 or Article 9 classification. So just to show you how important it is for us. What I would like to mention as well is that, of course, we have been confronted to a number of difficulties, I would say, when implementing SFDR. And the main ones, to be brief, So there are three different ones I would like to mention. So the first one is the complexity of some notions and concepts embedded in the SFDR. So I'm referring, for instance, to taxonomy, principle, adverse impacts. And when I said complexity, this is especially a complexity for end investors. The second point is the amount of information to be disclosed. So here, this is a key topic because in some cases, this information does not seem to be very useful for end investors. And once again, sometimes we have complexity in this information, and it is clear that it is not used by end investors. And the last point I would like to mention is the fact that, and it was mentioned by Osgur during the presentation, is that today, so we have the Article 8, Article 9 classification, but definitely there is a lack of common and clear criteria to define what could be in Article 8 and Article 9 products. So these are the main difficulties which have been encountered with the SFDR implementation. And with the revision of the SFDR framework, of course, it will be very important to address these difficulties. So I will not be very long, but what I would like to say is that as an overall comment, there will be a need for simplification. So this is the key element. And we can see things with two different perspectives. So the first perspective is a client perspective. So we need simplification for end clients. And my key message on this point is if we introduce some new categories, and probably it will be the case, these categories should be used to define the sustainable preferences of end clients. So it means that these categories needs to be very, very simple, clear in the way they are presented. And the existing criteria we use today, so such as taxonomy, sustainable investment, principle, adverse impact, they need to be removed and be replaced by these categories. When I talk about simplification for end clients, I'm talking also about the reporting requirements and the information that is provided to end clients. And we need to shorten significantly all the information to be disclosed. And the second perspective is what I call the investment perspective. And on this point, I refer to the need to introduce common, clear, measurable, scalable criteria for each category. Because if we do not have this type of criteria, probably the situation will not evolve significantly. And at the end of the day, we could end up with a situation similar to the one we have today with Article 8. So it means a broad range of products with different approaches regarding ESG integration and all the critiques we have faced today about greenwashing. So we need to be very, very careful when identifying, selecting the criteria, and make sure that with this selection, we do not end up with a situation similar to the one we have today. To respond on your last question about sustainable investment, very shortly. So this is exactly what Osgur said in the presentation. When the sustainable category will be defined, if we limit the criteria to taxonomy alignment, probably it will not work because the investment universe will be too restricted and we will have a risk to end up with a category for which there are no products available for end investor or a very, very limited number of products. And I think this is something that needs absolutely be avoided. Otherwise, this is the credibility of this new categories that will be at stake. So using only taxonomy, in my view, is not relevant, and especially in the context of the current discussions with the omnibus package, and the proposals which have been made in the consultation about taxonomy delegated acts. So I stop here. Thank you.
Thank you, Laurence. So there's a lot there. And sorry?
Can't hear you.
You can't hear me. Dear.
We can hear you, Nicholas.
We can hear you well.
You can hear me. Okay. Okay. Thank you very much. So no, I was saying, Laurence, there's a lot there. And Helene, I'm sure you were busily taking notes. And I'm going to turn to you. I mean, you know, of course, we'd be very interested to know what is the current thinking at the SFDR, you know, within the simplification agenda, and after obviously the very important impact of ESMA's guidelines on ESG fund names. So the first thing is, you know, what is your current thinking on the review of SFDR? And then there's this point which Laurence picked up on, you know, what's the role of the taxonomy as a benchmark for you know, for sustainability, and particularly when you talk about it in a regulatory perspective with defining sustainable investments. So over to you, Evan.
Thanks a lot, Nicholas, and good morning, everyone. Yeah, so in fact, a lot of aspects that we can discuss in this webinar. So let me maybe start by sort of recognizing that the preparation of the SFDR review, which started, I mean, the assessment on the functioning of SFDR started a bit more than 2 years ago. And what I find interesting is that it's been a journey. Because I think the way we were looking at the SFDR review, I mean, even a few months ago, not so long ago, has changed quite significantly as a result of the many recent developments, regulatory developments on the one hand. I'm going to mention a couple of them, of course, but also geopolitical developments. I think it's a very important aspect that we will factor in the preparation for the SFDR review. But so this, if I can put it like that, the sense of getting it right and well calibrated is sort of constantly evolving in light of this constant developments. So if I can maybe focus on a few important aspects. So on the one hand, I think Hortense made a sort of a very clear presentation on the impact of the guidelines on funds names. I think we were expecting that they would be extremely impactful for the industry. This is now proven. I think some of the figures we've received show that the industry has been investing, I mean, in particular asset managers, because as you know, the guidelines apply to funds, not to all investment products covered by SFDR. But so the fund industry has been investing a lot of time and resources to reviewing their, of course, the name of their funds, but also the portfolio composition, marketing documentation, I mean, all the accompanying material to align with the guidelines. So it's a fact. I mean, we have to take into account the existence of those guidelines, the impact that they've had on the market when preparing the SFDR review. And the reason why I'm saying that is because, as you know, this new commission has a mandate of delivering on simplification, burden reduction. And so we need to avoid a situation where we would come up with a completely disruptive approach for the SFDR review, which would potentially entail major additional costs for the industry to have to relabel and reassess entirely their product offer. So I think we're very mindful of this, the impact of these guidelines, and we'll take that into consideration for the review. Another interesting element of this linked to the application of the guidelines, but also more broadly, I think linked to the fact that the industry has been looking at the possible options for the SFDR review, notably on the product categories, is the fact that there's a sort of a very delicate balance to be found between ensuring convergence without being too prescriptive, which risks killing innovation. And I think in the ESG sector, innovation is crucial. We've seen a lot of new type of investment strategies developing in the market. I mean, new ways to deliver on the transition objectives. And we certainly do not want to kill that innovation. We believe it's extremely important. It's also one of the reasons why the EU will remain competitive, precisely if we are able to deliver in light of investors' needs and investors' appetite for ESG products. I think we need to create a system in a categorization system which also allow for this innovation to continue. So again, the balance is to be found between convergence and harmonization and coming up with criteria without deterring all these alternative investment strategies that could develop in the market in the coming years. And that's really a difficulty. I mean, I hear completely what Laurent said before on the need to be specific, to facilitate the comparability between the products and to facilitate also the communication to retail investors in particular. But we cannot be prescriptive up to a level where if you don't squarely fit into the defined criteria, you can no longer call yourself an ESG product. So I think in particular, I think we'll hear from Vanessa in a few minutes, I mean, how the UK FCA has been looking at it. But I think the principle-based approach that the FCA has implemented is a really interesting way to look at this. It's fair to say that we can't really replicate the exact same model in Europe. The reason being that we have 27 different jurisdictions, which may be tempted to implement the rules slightly differently. So once again, as part of the many constraints that we have for the SFDR review, we need to strike the balance between convergence, harmonization, but I'm acknowledging also that we rely on different NCAs to supervise. One word maybe on simplification, because I think this, I mean, Laurence also mentioned that this should be a priority for the review. Yes, of course, we have that very much in mind. So we will be looking at how to simplify, of course, disclosures, the templates in particular, because I think we've heard the message that disclosures currently are too complicated and for retail investors, they're simply impossible to translate into concrete decision-making for their investment priorities. So that's a message well taken. But when we speak about simplification, there's another aspect which I think is essential, is around the very concepts that underpin the SFDR. In the open public consultation, a lot of the feedback we received was on the applicability of the concept of sustainable investment, and in particular on the DNSH, do not significant harm principle, linked to the principal adverse impact indicators. And I think a lot of the respondents to the consultation pointed to the lack of legal clarity and comparability in the consideration of PAIs. So in the review, we will be exploring ways to simplify the DNSH. And maybe we are even considering whether the use of principal adverse impact indicators is the best possible approach, especially in light of the changes to the scope of the CSRD, or whether there would be possibly alternative ways to implement this concept of DNSH, even building on the approach of exclusions that ICMA has adopted for its guidelines. So those are things that we are sort of playing a bit with, because we certainly need to simplify the implementation of the DNSH. On the categories, okay, maybe I'll come to that later in the conversation, because I think there's a lot to say on the categories. But maybe to reply to a question on the role of the taxonomy, Nicolas, because I think it's in fact a very important question. I think whatever happens in the context of the omnibus negotiations, so revised CSRD, I think the taxonomy will remain an important benchmark as a system of classification of environmentally sustainable activities. Even before the modification of the scope of the mandatory reporting, I think it was not possible to say that the taxonomy was the only benchmark, as it was not covering all sectors and all type of activities. What we're providing for in the revised scope is the possibility for stakeholders, for companies to report on a voluntary basis. And we tend to demonstrate that those companies that can demonstrate their alignment with the taxonomy will actually continue to do so send a message that is attractive to investors. And as Hortense said it at the beginning, the appetite for ESG investment will remain and will actually continue to grow. So the fact that the potential scope of the taxonomy is reduced is, of course, having an impact, especially for FMPs who will receive less data under the taxonomy regulation. But I think in terms of signaling effects, it will remain an important driver. So I think we can remain positive on the ability of the taxonomy to keep its visibility and keeps its importance for the financial sector. I'll stop here for now, maybe.
Maybe just a quick follow-on question, Hélène, and again, you may not be able to respond, but just on the taxonomy, one of the we've been very vocal about usability issues in the taxonomy, and we, in our report, we, obviously speak to the importance of being able to use other methodologies or metrics around sustainability. But one of the key points we made beyond significant harm is the possibility of demonstrating partial alignment, because some of the aspects of taxonomy are easier to demonstrate than others, and particularly significant harm is challenging. Do you see any evolution in the thinking of the Commission on that front, or is it too early to say?
So if you're referring to the possibility for financial market participants to use a partial alignment with the taxonomy to meet the conditions of one of the future categories,
for example,
I think that's something that we are open to explore, I would say, as part of the many ways to meet the conditions. When I was referring before to the fact that we need to keep this flexibility and this the possibility for FMPs to innovate, I think that's possibly one of the areas where we have to remain a bit open, because if we envisage a model whereby only purely taxonomy aligned products and funds can meet the conditions, I think that's, first of all, extremely restrictive. I think that we can hear. And second of all, it will have a pretty disruptive effect on the market compared to the current situation. So that's where we have to strike the balance and acknowledge that, things have developed, the market has developed different types of practices, investment strategies, and many of those strategies are valid, in particular for the transition, because I think that's, I didn't discuss the product categories, but the transition category, even though the name itself might not be used by a majority of the funds, as Hortense said at the beginning, but I think in terms of the ambition of the products, a lot of products have the ambition to contribute to the transition. And so there can be different ways to do that, and it's fair to say that the product categories could recognize these different models.
Very good. Well, thank you then. Now it's time to turn to what's also been happening in parallel in the UK. So Vanessa, the UK has been very active also here with the SFDR implementation. Can you give us a progress update and any feedback on the implementation process? And do you already have lessons learned on what's worked or emerging challenges?
Thank you very much, Nicholas. Yes, absolutely. And as Hélène mentioned, it is a journey. I think SDR has been a journey for us as well, both through the policy development and then most recent implementation phase. I think before jumping into numbers and progress, I thought it would just be helpful to recap the objectives we were seeking to achieve from the policy. So these were threefold. First was to minimize greenwashing and protect consumers from associated harm. Secondly, it was to increase the provision of standardized sustainability information across the investment value chain. And then finally, to enable consumers to use labels and disclosures more effectively to navigate the market. So this is really a consumer-focused regime. We wanted to create a landscape where firms both evidence their claims and then consumers can trust in those claims. There's been a lot of focus on the labeling aspect of the regime. I think it's just worth reminding everyone that SDR is actually a comprehensive package of measures. So there's mandatory naming and marketing rules, an anti-greenwashing rule, and then voluntary labels. And it's really this kind of overall package that delivers back to these outcomes that I've mentioned. In terms of our naming and marketing rules, they restrict managers from using terms sustainable, sustainability, and impact in the name of an investment product unless they are using an investment label. And then we have guidance on the use of sustainability names, where we say that we consider a name to accurately describe sustainability characteristics of the product if 70% of the assets have those characteristics. Other than that, firms need to ensure they use terms that are appropriate and accurately reflect their products and services, and in doing so, they refer back to the anti-greenwashing rule, of course. But I guess our overall message and intention was not for SFDR or our anti-greenwashing rules to restrict firms' ability to accurately describe something. It was really rather to ensure that consumers can take comfort in what is being described by firms and get essentially what they're being presented with. From an international perspective, we really hope that SDR is also a step towards harmonizing practices, both domestically and on the global stage. We learned from what the EU has done as a first mover in this space when we were designing our own regime. And although I think it's worth just remembering to my first point that the starting points for the regime are different, with ours being a consumer-focused regime. We're still, though, very, very supportive of compatibility between the two. We're also engaging on the global stage to ensure that we are engaging with other counterparties and jurisdictions who are looking to develop similar rules. Moving now to the progress update. So SDR is still a very new regime, and we appreciate that it took time for firms to get to grips and to really familiarize themselves and adapt to the rules and standards. Our intention was to raise the bar, and I think it's just worth remembering that this is not easy and shouldn't necessarily be easy. So it has taken some time, but we're currently aware of over 130 funds using labels across all 4 labels. And that includes funds where we have approved disclosures as well as unauthorized AIFs. And we're also seeing firms changing the names of their funds to comply with naming and marketing rules, and also producing consumer-facing disclosures and having more accurate pre-contractual disclosures. I think it's still relatively early days. We are encouraged with the research that is coming through, but we need to continue to monitor the market and look at further success measures down the line. In terms of the challenges we face, this really speaks to the point that Hélène mentioned around principles-based regulation and finding that balance. We did take a principles-based approach to the rules, which was very much welcomed by firms. So this provided a level of consistency in the types of information disclosed and only required information that was relevant to the product's objective. So our SDR rules do not limit what funds can invest in. We've not been prescriptive on the metrics firms use, and we've not required that firms use a taxonomy to evidence how they meet the requirements to use a label. So we did this really to allow room for growth and innovation within the investment market. The flip side, I guess, is whilst this flexibility was very much welcomed by firms, it did present some challenges in implementation. We needed to really support firms along the way. So we provided extensive support through webinar, actually both from within our sustainable finance policy team, our fund authorizations teams, and fund supervision teams. So we really had to work together as an organization to support the implementation of this policy. We attended webinars, forums, we kept our webpage updated with information and clarification for firms, and the teams held quite a few bilateral meetings and pre-application calls with firms. They also met with firms throughout the application process. I think what made a key difference as we were progressing with the implementation, at least from a labeling perspective, was in late last year, we published examples on our website across all 4 labels. So these examples kind of form a basis for firms to consider how they may want to evidence their sustainability claims. But again, it's really important to note that these examples need to be adapted to the specifics of individual investment strategies and portfolios. So again, there's no one size fits all. Overall, I think the measures helped firms to gain a greater understanding of the requirements. And as a result, we've seen quite an uptake in labels over the last, I would say, 6 months. In terms of what firms can do if they are looking to approach us to use a label, I tried to distill this into 3 top tips. There's plenty of information on our website, but overall, good fund label disclosures should include objectives that are clearly defined and specific. They need to clearly articulate the due diligence undertaken to select robust evidence-based standards and KPIs that are linked to the objective. I think this sustainability objective is really important because everything else from the standards, the KPIs, the stewardship approach hangs from it. I think overall, we're in a very good place now, and we think that the process going forward will be much quicker now that firms are familiar with the regime and the types of questions that we ask. And essentially, our message to firms is that if you're going to use a label, if your disclosure clearly sets out what you're going to do, what you're investing in, and you're ready to come to stand behind those claims, it should be a relatively smooth process going forward. Don't know if it's worth me speaking at all on our kind of next steps for expanding SDR, or if you'd like to leave it there, Nicholas.
If you quickly want to, I think it would be interesting to our audience to hear that. So if you could quickly tell us about that, that'd be great.
Sure, I'll keep it very short, but we've, in terms of our next steps for expanding SDR, we have recently said that we are pausing the extension to portfolio management for the moment. Whilst firms supported the extension, they wanted more time for SDR rules to bed in the fund space, and also some wanted more clarity on our approach to on the approach to overseas funds. I think in taking more time for portfolio management, we're also looking to see any relevant findings that come out of our broader model portfolio services review. But we are looking forward to seeing the regime expand in the future.
Thank you very much, Vanessa. Before we go to the Q&A, I've got a question for all of you, and this flows one from a topic in the market, which has actually been picked up in some of the Q&As that I've just received. This is the challenge of transition and how that is taken into account by the sustainable fund industry. And we have published on the way the debt capital markets can address transition. And one of the points we made is it's very important to distinguish between different types of transition. There's the sort of energy transition or the green transition. And then there is embedded in this, there is or overlapping with this, there is a harder nut to crack, which is hard to abate in fossil fuel transition. And this is something which in the arguably in the both in the work that ESMA has done with the guidelines and also in SDR, there's been an attempt to create a category for transition. And the question I have for all of you is, to what extent do you feel that the creation of a specific category can help move what we can arguably call hard transition?
Maybe I can share my view on this. I think I actually see transition, the concept of transition and the strategies that are related to transition today where ESG or sustainability was 5 years ago. It's actually very hard to define. There are many different types using many different measures. And I think we would be stifling innovation if today we were putting transition, if we were creating a transition category, actually, to be very clear here, because there are many different ways of tackling this issue which is extremely important. The transition actually is probably the most important thing today, right? We have very few companies that are green. And we can refer to the taxonomy to see that how complex it is to report on green activities. The focus of the action plan on sustainable finance in the EU was to channel capital towards sustainable activities. So activities today that are brown that will become green in the future. And it's very hard today to put some rules around that, because it depends on the asset class, it depends on the sectors, there's so many things that are really so new to everyone. And everyone today, the reason why we don't have that many transition strategies, by that, strategies that have the word transition in it, is because also investors have to grapple with this idea. And there's a lot of education to be done there. So I think it's not the right time to do that. I have a very, very strong view on this. Let the market, I think we should let the market just do his thing, and then and see if it works, because it's too delicate.
That's really interesting. I actually want to comment on that, but I don't want to preempt, the panelists. Anyone else would like to jump in with their views on this topic?
Yeah, Nicolas, if I may, just before answering to your question, so I would like to come back very shortly on what Hélène said previously about innovation. So of course, I would like to avoid any type of confusion when I say that we need a common, clear criteria for each category. So the objective is not to kill innovation, for sure. And on our side, we even consider that it will be necessary to adapt the criteria to different type of asset classes. So for instance, I will take only one example, but I could take different ones. When you look at private assets, it is clear that in that case, we will need to adapt the criteria, because otherwise it will not work. So the objective is not to be too prescriptive, but to identify the different ways. And for each category, there are different ways to have a product qualifying for this category. But once we have identified these different ways, we think it would be useful to have this type of minimum criteria. And Vanessa explained very well the challenges today with the principle-based approach. So we need to be careful, because what we need to keep in mind in the end is that the objective is simplification. Simplification, and what we need to do is to provide comfort to end investors. So if you have some categories for which it is not clear what you have in this category, and the client needs to go through all the documentation to know exactly why a product is in this category, I think honestly, it will not work. So I stop on this point, and I will answer to your question about transition. So of course, transition is very important. One benefit of introducing the new category is to have this transition category. So today, when we look at Article 8 and Article 9 classification, it is not really possible to flag products which are some transition products. So here, of course, there will be some challenges. And of course, what will be essential is to define what we mean by transition. So what is transition exactly? So once again, it does not mean that there will be only one way for a product to be a transition product, but I think we need to provide clarity on that. On our side, I don't want to be too long, but there are two key points, two attention points we have identified, and probably there are many other ones. The first one is it will be very important to clarify if both on a line-by-line approach and a portfolio-based approach will be valid to have one product in this transition category. So it will be necessary to be very clear on that, because if we don't know, it will be a big mess. So this is the first point, need to have full clarification on that. And another point I would like to mention is that in our view, it will be very important that both assets in transitions and assets needed for transition are eligible. So what I mean is that if we limit only this category to assets in transition, we will remove a lot of companies that provide today critical products and services for the transition, and it would be very bad that these companies are removed from the scope of eligible companies. So I'm thinking, to be more concrete, maybe I'm thinking about the companies that provide solutions on renewable energies. You see, so their activities are taxonomy aligned. Okay, so but they are not going to be in the sustainable category, but they provide solutions for renewable energy. They are not themselves in transition, but they contribute to move to transition. And we think that it is very important that these companies are also eligible to this transition category. So I will stop here because I'm conscious of time. Thank you.
Thank you. And then Vanessa and Ellen, quickly, so because I also want to come back to some of the Q&A questions, but please.
Thanks very much, Nicholas. I'll be super quick. So I just thought I would just reflect on the SDR approach, where we have our improvers label, which essentially, when we went out to the market and canvassed consumers, what we found actually very interestingly was that the term transition wasn't necessarily well understood. So we went with the label improvers instead, which we found consumers understood better. Just a couple points on that label. The category is flexible, but firms need to back up their claims. And I think, just from our perspective, we do think that labels have an important role to play here. But again, where they're voluntary, firms can either choose to seek a label or can revert back to naming and marketing. I think it's worth coming back to Laurence's much earlier point on the wider ecosystem around disclosures, around good quality information that is coming out into the market, around transition plan disclosures as well. I think overall, holistically, this wider ecosystem will support, together with the fund labels, taking us all, I suppose, to a greener future transition. So I am optimistic. I think, though, there's a lot of cogs in the wheel that need to come together in this space.
One very quick final, maybe, word from my side. No, very, very complex topic, this discussion on transition. I think we probably need a transition category. I hear Hortense's sort of concerns of misgivings on our ability to correctly capture the notion of transition. I think it's fair. It's a complex discussion, but I think I would say it's the number one ask from the industry to have a transition category that allows, precisely as I was explaining before, to cater for these very different investment strategies that, I mean, have a sort of a long-term objective. If we don't have that, if we just have a sort of an ESG category and a sustainability category, I think there will be a big missing piece. And I think, I mean, consumers on the one hand, investors and the industry will not understand why we don't do that. However, what is also true is that SFDR is not the place to define what a transition product is. And that's the really tricky aspect of this discussion. We probably want to develop a product category, but we don't want to have a sort of a taxonomy type of discussion in the context of the SFDR negotiations. Because SFDR should in principle simply reflect the reality and the maturity of the financial ecosystem. I don't think it's really for the SFDR negotiations to have to trigger long discussions and debates with the co-legislators on what is the transition. But okay, that's maybe more of a general remark, because I know it's going to be one of the most difficult aspects of the SFDR review.
Thank you very much, Hélène. And just and apologies for jumping in, but having just come back from Singapore last week, and one of the things that we do at ICMA is to try to make sure that we take into account as much as possible the global view, and this is where Asia is I think really contributing to the debate. Is when we talk about transition, there's been some significant evolution and progress in the official sector space around transition-based taxonomies, which again we've seen through several publications from major jurisdictions out of Asia. And without going into detail, one, they propose a traffic light system. So it's not just about green, it's also about amber and red categories. And they also set sunset dates for certain industries. And I would argue that this is much easier for market participants and provides, again, an official sector anointed way of looking at transition, which, and with no disrespect to you, taxonomy, works better when you try to apprehend transition. And again, we don't have time machines. And when the EU taxonomy was being developed, the topic which was being addressed is what is green or not. It wasn't necessarily, what is the transition, particularly hard to abate and fossil fuel transition. And this is where, again, Asia's in a different space. It has a lot more heavy industry. And so they focused on that. So I think it's important in the UK, or, if I may, and in the EU, when we look at this, is to look at what's been done in other jurisdictions so that we're not reinventing the wheel and taking into account, I think, some really interesting progress in thinking coming out of both the market and the official sector. Now, just with the night time, we've roughly got 5 more minutes. There was a lot of questions on transition in the Q&A, and I think this conversation largely addressed it. But interestingly, what has creeped into our Q&A, and I don't mean that in a negative way at all, is this question around defense. And this isn't something we had thought about, I think, in preparing this webinar, but we have had a number of conversations at ICMA around this topic, and I'd be interested if any of our panelists would like to comment on the degree to which defense issues can be covered by ESG or not, and also specifically in the context of Article 8, Article 9 funds, we've seen metrics which demonstrate that it's not just about these funds avoiding controversial weapons for which there are definitions, but actually avoiding completely the defense and aerospace sector. So going much more widely, and just looking at those numbers, you think, well, this is an overshoot. But I'll stop there. Does anybody would like to jump in and comment on this important topic? Hélène, over to you.
Yeah, absolutely. Well, super important question, extremely, topical. I didn't expect when we started the SFDR review that we would end up actually have long conversations with stakeholders on defense, but it's justified and very good to develop a sort of a vision on this. So what I've been saying on many occasions recently is, well, first of all, but I suppose it's clear for the audience today, because I suppose they're mostly people who know the framework quite well. So nothing in the sustainable finance framework prevents any investor from investing in the defense sector. The only prohibition concerns controversial weapons, and it exists in relation to the Paris-aligned benchmarks and climate transition benchmarks under the benchmark regulation. So the sustainable finance framework in the EU doesn't prevent investment in defense, and there's no reason for us why it should be the case. The more difficult part of this discussion is when we move to the question of whether we should cater for either a specific defense category under, in particular, the SFDR, or even whether we should recognize that investment in defense can contribute to a social sustainability objective. That's when it becomes, I think, more interesting and difficult. Again, I'm speaking really on a personal level. My answer to that at this stage would be to say, I don't think there should be a presumption that investment in defense contribute to social sustainability. I think we can say there's no incompatibility. So if financial market participants can, on a case-by-case basis, demonstrate that certain investments can contribute to their social sustainability objectives, yes, possibly that's the case, and they can then back these claims and demonstrate how. But I'm not convinced that we should either go for a standalone defense category in the SFDR, simply not the right place, in my view. And again, on this idea of contribution, I think we have to be very nuanced. We can speak about the perfect compatibility between investment and our sustainable finance framework, but I wouldn't go as far as saying that by construction or by nature, investment in defense or have a social sustainability objectives. But again, more of a personal opinion, I would say.
Vanessa, over to you.
I'll just come in very quickly. I think Hélène very eloquently explained the position, which is actually very similar to the FCA's position. We did put out a statement on defense, and we've made the same point that our sustainable finance initiatives do not, and policy does not prevent investment. But what is really, really important is the emphasis on transparency. So again, firms need to be able to stand behind their claims, and they need to be able to be very, very transparent so that consumers can make choices that align with their investment values and judgments. But there's more information on our website on that point, but it is very topical, and I think further discussions probably to come internally and with the wider international community, I would say.
Thank you very much. We're almost well, actually we're at the time that we had planned to end the webinar. I don't know if I had actually in the Q&A a very open question about, are there other key challenges that we haven't talked about? So it's actually not a bad way to finish. I mean, are there things that you haven't been able to speak to or challenges which you'd like to underline quickly before we end this really interesting conversation?
So maybe one last point. I mean, we talked about simplification. We talked about a lot of different topics, and I also want to stress the importance of the role of asset managers. And at the moment, as you know, the political environment makes it difficult for managers, to offer the products that address investors' need, or even have the conversation that they would like to have with clients. And some are even rolling back their commitments. And this is like a pretty bleak backdrop. So I would think, I think the market doesn't need another layer of policies. That's all I wanted to say. So I think we should, in fact, instead of creating categories, we should just simplify Article 8 and 9 and just improve what we have instead of adding another layer of potential complexity with results that would be very unknown. It would be another gamble. So I have a very strong view on this.
Thank you, Hortense. Laurence.
Yeah, thank you. So I can only concur with what Hortense just said. And as I often said, so when we answered to the consultation at the end of 2023, so our preferred option, to be fully transparent, was more to keep Article 8 and 9 classification and see how we could leverage on what we have today and how these could be improved. Because once again, if we introduce new categories, we absolutely need to make sure that they will really improve the current situation and simplify this framework for end clients. If it is not the case, honestly, what is the benefit? What is the benefit of that? And what we need to keep in mind is the end client. So Vanessa explained very well that the SDR framework is consumer focused, consumer oriented. So I think we need to have the same approach in the EU, and we need to keep this in mind. And we need to make sure that sustainable preferences will be modified, that we will not keep the very complex concepts we have today. So it is very important. Very two last points I wanted to mention. So of course, but I think it's obvious for everybody, we need consistency with the current so the modifications we will have the omnibus package. It is key as well. And on this point, I want to be very concrete. So we talk about taxonomy, okay? So it seems that it will be more difficult for financial market participants to get data on taxonomy. And Hélène said it will remain very important as a very important benchmark. Okay, but in that case, what do we do when one company decides not to publish its alignment with taxonomy? How do we deal with this type of situation? And what will be the value of the information we will provide on taxonomy alignment for our products? So this is typically the type of questions we need to address, because otherwise, once again, the review will have no added value. And very, very last comment, I think it is very important to associate as much as possible the industry in all these discussions about SFDR revision. We need to draw lessons from what has been done so far. It is very important that a pragmatic approach is retained. And honestly, in the industry, we have a lot of things to share with public authorities on how we have implemented SFDR, the difficulties we have encountered, feedback from our clients as well. Feedback from our clients. And I think that distributors should be more associated indeed to this review. So it is very, very important to have industry associated, and having a kind of expert groups, this type of thing, in my view, could be very useful. So thank you.
Laurence, thank you very much. You know, we could continue, but you know, we have come to time. So thank you also, Hortense, Hélène, Vanessa. It's been a great conversation. I'm sure that, and I certainly hope that our viewers, you know, also took away as much as I have. But with that, I'm going to close this webinar. Thank you again, and until the next, you know, interesting topic, which we will cover in a future webinar. Bye bye.
Thank you.
Thanks a
Thank you.
lot.
Bye.
Thank you.
Mm-hmm.